Hi everyone, thanks for joining the webinar. My name is James Melly and I'm the Practice Leader for Tax at LegalVision. Today we're going to talk about some of the business structuring basics, or business structuring 101, the various types of business structures people can use. What are they? Generally they have advantages and disadvantages, but how do you sort through what benefits you and why? So the first and most simplest business structure is a sole trader, and that's what we'll kick off. But overall, there's sole traders, there's partnerships, trusts, which we'll go into, and the different types of trusts, because it's important to know how the particular structure you adopt operates, how it's controlled, how it's taxed, who is taxed, and when. We'll also be talking about companies, although they're much more well known than some of the other structures, and importantly, combinations of them. And you may want to use combinations in order to cherry pick, for lack of a better word, between different advantages of different entities. And again, we'll touch upon that in a moment. So, sole traders. A sole trader is when an individual carries on business personally. The advantage is it's simple, simple to set up, simple to operate. Everything in terms of income or losses goes into your personal tax return, and that may be beneficial, particularly in startup mode. If you're incurring business losses, you can use those losses to offset your income from other sources. So, for instance, if you're transitioning to a business from a full-time job, then you can use early stage business losses to offset your salary and wages income, which can be advantageous in those circumstances. The big downside of a sole trader, or operating as a sole trader, is that your personal assets are at risk of business creditors. For example, because there's no separate legal entity, everything is lumped into the one bucket, being you. If, for instance, you incurred business debts, creditors of the business can go after obviously any business assets you have, but also your personal assets. So if you have a house, for instance, business creditors can get at that personal asset, a very important personal asset in your main residence. So overall, even though it's quite a simple structure, inexpensive to set up and operate, it's really not good from an asset protection perspective, and on that basis, it's not as common. The next business structure is a partnership. A partnership is two or more people or entities carrying on business in common with a view to profit. So two or more people coming together in order to make some money. The benefit of a partnership is that income is split amongst the partners. However, one of the biggest disadvantages is joint and several liability. Now what is that? If I was a creditor of the partnership and the partnership business or vehicle owed me money, then I can go after any individual partner for the full amount of what the partnership owes me. So for instance, if I'm owed $100,000 and there's two partners in the partnership, 50-50, I can go after one partner who may happen to have significant assets for the full 100,000. I don't have to chase each partner in respect of their share of the partnership, for instance. So asset protection from in the context of a partnership is not great. However, this is where the issues of combinations of entities can come into it, because if the partners happen to be companies or trusts, then the inherent nature of that partner gives you a measure of asset protection, even though a partnership vehicle overall, giving rise to joint and several liability, isn't itself a great structure. Now, partnerships do not actually pay tax. It is the partners who pay tax, or the partners that share in partnership losses. Now, they are still required to lodge a tax return, but that's really just a data matching tool that the ATO used to look at what was returned by the partnership look at the income or losses which flowed out of that partnership to the particular partners, and then they cross-check that in terms of the individual or entity returns of the particular partners to make sure everything marries up. Excuse me. The next business structure is a trust. Now, a trust is not at law a separate legal entity. It's just a relationship between the trustee who holds the legal title to an asset, but not for their own benefit, for the benefit of the beneficiaries. So there are different types of trusts. There can be fixed trusts, which often include unit trusts, where the beneficiaries have a fixed proportion of income or capital of the trust. For instance, if there were 5 equal unit holders holding 20% each, they would know each year, whatever the trust makes, they would get 20% of it. Now, losses, however, are trapped in a trust, regardless of whether it's a fixed trust or a discretionary trust. And what that means is that unlike a partnership, if a trust incurs a loss, then it stays in the trust. You can't distribute it out to the beneficiaries, and the trustee can carry those losses forward to offset its income in future years. But the ability to apply those losses in future years is subject to various loss tests. Now, the next type of trust is a discretionary trust, and you may be familiar with the term family trust. And a family trust is generally understood to be a form of discretionary trust. It's where, unlike a fixed trust, no one has a fixed entitlement, none of the beneficiaries, and the trustee from year to year has the discretion as to whether any beneficiary gets anything, or the income could be accumulated, or if they're going to distribute the income, who gets it and in what proportions. So it's a very flexible vehicle. In fact, structurally, it's the most flexible vehicle in ownership vehicle in terms of carrying on a business or carrying out an investment. So trusts generally aren't taxed. So in that sense, the starting point is that they're like a partnership in that they're a flow-through vehicle. However, there are circumstances where a trustee can be taxed. So if at the end of the year, the trustee distributes all the income to the beneficiaries are taxed on their share of the trust income. They just put that in their income tax return and pay tax at their marginal rate. If a trustee accumulates income, that is, the trust generates income, and at the end of the year, the trustee says, I don't want to distribute anything, I'm going to keep it, then the trustee is taxed at a flat 45%, so not a great tax outcome. There are circumstances as well where, because of some technical deficiencies in the distribution minutes, the trustee hasn't done enough to distribute all of the income out of the trust, and any residual amount can be taxed to them unless there are special clauses in the trust deed which create default beneficiaries, which is basically a saving provision to say if the trustee doesn't distribute everything in a particular income year, in order effectively to prevent the flat 45% tax in the trustee's hands, the income flows through to A or B in equal proportions, and that's a bit of a backstop to prevent such high residual tax rates. So the next structure, is a company. Now, companies are generally very well known, but we do get a lot of questions as to how they actually operate. Now, a company is a separate legal entity, so it can sue and be sued in its own name. The shareholders generally aren't liable for company debts over and above whatever they've put into the company in terms of share capital. Companies are taxed at a relatively low flat tax rate, so it's 30% for a lot of companies, or 27.5% for what they call base rate entities, which is essentially certain small or SME businesses with aggregated turnover of under 25 million, although that's changing. There is a stepped reduction in the corporate tax rate over time, and whether you qualify for the lower rate in a particular income year
press any key to continue this conference.
Depends on whether you qualify under the law at that time. So it's definitely something to be wary of. Now, some of the benefits of companies, particularly in the startup space, is that certain concessions are only available to companies. So the biggest one being the R&D tax incentive, but there are certainly other grants only available to companies. So if you structure as a trust or a partnership of trust, a sole trader, even though from a commercial perspective, there's no difference between you and a startup run by a company, you are specifically ineligible for those incentives. So that is definitely something to keep in mind when you're thinking about structure. So companies are also well understood with regards to financing and raising capital. So even though they're not necessarily tax issues, other things being equal, it's much easier to raise capital into a company structure, for instance, or obtain finance compared to trying to raise capital if you operated through a unit trust, for example. Also, one of the big disadvantages of operating through a company is that unlike individuals or trusts, companies are ineligible for the 50% capital gains tax discount. Now, you may be aware that if you hold a capital asset for at least 12 months and you're an individual or a trust, then you can halve the capital gain, take the first half completely tax-free, and then you only include the second half in your assessable income. So overall, you're paying about half as much tax. However, in a company structure which aren't eligible for those concessions, the ordinary rules would apply. So the company would pay its flat tax at 27.5% or 30%. It would pay a dividend out to shareholders, and shareholders can pay up to 45%, excluding levies, but they get a credit for the amount of tax the company has paid. So long story short, you can pay significantly more tax in an exit scenario by operating through a company, but there are two caveats to that. The first is, if you're an individual shareholder or you operate the business through a company, but its shares are held by a trust, then if your exit is by way of a share sale rather than an underlying asset sale by the company, then the entity triggering the capital gain is not the company, it's actually the shareholder. So if the shareholder is eligible for the capital gains tax discount, then you can end up paying half as much tax that way. So that's something to keep in mind in terms of negotiating an exit and how it's done. Now, anecdotally, it's less common for people to acquire shares in a company rather than the underlying assets, and that's often a function of perceived risks. People are afraid of potential skeletons in the closet and would prefer to take the assets out of that entity and put it into a new entity to operate going forward. But this is something that is certainly open to negotiation. So whether certain warranties or retentions, and even the type of business and whether the perceived risks are in the realm of possibility. But having that dialogue, negotiating a share sale, other things being equal, the vendors are in a much better tax position. So this is a common question, which structure is best? And I always tell everyone there is no perfect structure or one size fits all approach. What is best for you and your circumstances depend very much on your particular situation, the type of business involved, the funding requirements. For instance, excuse me, if you're going to operate a business that requires external equity, then you may wish to operate through a company because it's a tried and tested route of raising capital. If the business is going to have significant working capital requirements, then a trust may not be beneficial because all profits have to flow out each year to be taxed in the hands of the beneficiaries and then have to come back down into the trust somehow, whether it's debt or the further subscription for unit capital, just in order to fund the business for the next year. So it's a little bit clunky compared to a company. But then you have the situation where trusts in an exit context have a clear advantage over companies unless you can negotiate a share sale. So looking at the situation, what is most likely to happen, the type of business, whether you're going to raise capital, whether there's going to be significant working capital requirements, all of those things feed into your initial structure. And there's no, generally, there's no perfect structure for you. You really just have to make sure that you look at the situation, choose the most likely scenario, and basically you structure accordingly. Now, obviously, life can get in the way of your plans, but if so, at least you've played the odds and you've structured for the most likely scenario. And given that no one has a crystal ball, that's as much as we can do. So can I change structure later? It is possible, and the short answer is yes. The downside is that it may potentially trigger tax and duty costs and professional transaction fees at that time. Now, from a tax perspective, any transfer of an asset will trigger an event, and then you have to look at, well, what have I spent to date? Is it worth more than what I've spent? If so, then that can be a profit or a gain. And then how is it taxed? The starting point would be that any gain is taxed somehow, but then you're having to look at, well, is rollover relief available, which is a circumstance in which, yes, you have triggered a gain, but economically there's been no gain. You've replaced it with an ongoing asset. And in those certain situations, even though you've triggered an event, you're not actually subject to a liability. If none of those rollover reliefs are available, then it's an ordinary disposal, and then you may be able to look into whether any specific concessions are available, like the small business capital gains tax concessions. If that's the case, then you can effectively restructure for little or no tax, depending on your circumstances, to get into the new structure which suits you for whatever reason at that time. Now, in terms of runway, sometimes I do get questions saying, well, at this stage, it's always a cost-benefit analysis. I'd like to hold off on setting up structures and I'll just do it later. If later you mean 3 months, 6 months, particularly in the startup context, if every day you're adding value, then every day you're potentially creating a problem by not structuring appropriately from the outset. So that's just a word of caution there. So thank you for attending the webinar. If you do have any questions, feel free to give us a call on 1300 544 755 or visit our website legalvision.com.au.